A rupee nearing rupees 96 against the US dollar is more than just a market number. And for an Indian family planning a foreign holiday, paying a child's college fees abroad or buying imported products, every fall in the rupee can mean spending more money. And in order to understand it simply, when $1 costs rupees 83, buying $5,000 requires rupees 4.15 lakh, but at rupees 95, the same $5,000 costs rupees 4.75 lakh. And that is an additional rupees 60,000 without buying anything extra. So is this weakness temporary, or are Indians heading towards a new reality of a permanently weaker rupee? So firstly, let us understand that what is the rupee under pressure? Well, the biggest reason is India's dependence on imported crude oil, and India is one of the world's major oil importers, and oil is largely brought in US dollars, and when global crude prices rise, Indian companies need more dollars to pay for oil imports, and this increases demand for dollars and puts pressure on the rupee. Brent crude was trading above $90 a barrel during the recent pressure on the rupee, while geopolitical tensions and strong dollar demand from importers added to the weakness. And on August 21, the rupee was hovering near rupees 95.70 per dollar despite support from RBI intervention. Global interest rates, foreign investment flows, and the strength of the US dollar also play an important role. And if investors move money towards dollar-based assets, demand for the dollar rises, and emerging market currencies, including the rupee, can come under the pressure. So how will it affect the Indian economy? Well, the first major impact is on imports, as India imports crude oil, electronics, machinery, and several other products. And as the rupee weakens, all these imports become more expensive in rupee terms, and higher oil prices can also raise transport and production costs. And this may eventually increase price of goods and services, adding to the inflationary pressure. A weaker rupee can widen India's import bill, especially if oil prices remain high, and that can put pressure on India's trade balance and current account. However, there is another side, as Indian exporters may benefit because every dollar they earn converts into more rupees, and IT companies, pharmaceutical exporters, and other businesses earning in dollars can see higher rupee earnings, although the actual benefit depends on their cost and the currency hedging. So foreign travel and education also get costlier. Well, the impact is immediate for ordinary consumers making payments in dollars, and foreign university fees, hostel charges, rent, and daily expenses become more expensive for the Indian students, and families sending money abroad may have to increase their budgets even if the dollar amount remains unchanged. Similarly, overseas holidays can become costlier. Air tickets, hotel bookings, and forex purchases may require more rupees. And for example, buying $5,000 at rupees 95 cost around rupees 4.75 lakh, compared with about rupees 4.15 lakh at rupees 83. So what is basically RBI doing? The Reserve Bank of India has reportedly been intervening in the currency market to limit excessive volatility, and market participants have seen state-run banks seeing dollars, which traders believe reflects RBI intervention, and this has helped prevent a sharper fall even as the rupee came under pressure from high crude prices and strong dollar demand. International news agencies reported that the rupee was around rupees 95.69 per dollar, with RBI intervention helping anchor the currency. So India also has a significant buffer, as recent reports said that foreign exchange reserves had risen above $700 billion and supported partly by strong foreign currency inflows, and this gives the RBI greater capacity to manage extreme volatility, although reserves cannot permanently fix all the pressure on the rupee. So is it temporary shock or the new normal? Well, there is no certainty that rupees 95 will become the permanent new level, and the rupee had also recovered to around rupees 95.56 on August 20 before moving again near rupee 95.70 on Friday, showing that how quickly global developments can change the exchange rate, and the next direction will largely depend on crude oil prices, global tensions, US interest rates, foreign investment, and dollar demand. So for now, the message is clear that a weaker rupee does not mean an economic crisis, but if does make imports and dollar-based expenses more expensive. If oil prices remain elevated and global uncertainty continues, pressure on the rupee may persist. So whether rupee 95 is only a temporary shock or the beginning of a new normal will depend on how these global and domestic factors unfold in the coming months. That's all for now. Stay tuned to the Savera for more updates. Do like, comment, and subscribe to the channel.